Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Hey everyone, before we get started, I'd just like to quickly mention that we're updating our website. So we at Commonwealth Home Ownership are dedicated to making financial and investing education accessible to anyone who wants it. To that end, we are making the tools and resources on our website free for our members. To find out more, please check us out at cwho.ca. Let's jump right in. Hey everybody, welcome to another episode of the Commonwealth Home Ownership Real Estate Podcast. My name is Phil, and as always, my partner here is Brad Price.
How you doing, buddy?
Good. And today we're going to cover the 10 steps. We're going to cover how to, sorry, we'll cut that bit. But today we're going to cover the 10 steps to get started in real estate investing. So we're going to go over 10 things that you should do to prepare yourself, your finances, in order to be in the best position to get started in real estate investing. So without ado, let's get started. Let's jump right in. Step number one, get your personal finances in order. So I mean, more than anything, it's super important is to make sure your debt's paid down. You have no credit card debt, because that doesn't look very good when you go to the bank to get financing. Just because all that debt will kind of, if you haven't read or don't know what a TDS or a GDS, your total debt or gross debt service ratio, you can read one of our articles on our website. But basically what it comes down to is the more debt you have versus your income, the lower the banks will rank you in terms of their ability to give you a mortgage. Is that right, Brad?
Yeah, basically. And not only that, I mean, it's going to make it harder to save money if you're trying to pay off credit cards. So, it's kind of hard to do both at the same time. So the sooner you can get rid of any credit card debt, the sooner you can start saving more towards getting into real estate. Mm-hmm. So, but yeah, absolutely. Like when it comes to GDS and TDS, like understanding your income versus your expenses, it's really important to get familiar with that so that when you do reach out to a mortgage broker or you apply for credit, in the form of a mortgage, that you're not surprised when they come back and say, wow, you don't make enough money. It's not necessarily you don't make enough money. It's just that too much of your money is going to expenses.
Mm-hmm. And you can calculate your GDS and TDS upfront, just so you know when you do approach the mortgage broker, just how you look to the banks before you get there. So if you're too far off before you even get there, that there's no point in applying, just because you need to get that debt down first before you apply for that mortgage.
Yeah, I think GDS, so gross debt service ratio, is calculated at no more than roughly 32% of
32
your income.
now, yeah. They recently updated those rules last summer, actually. Yeah, so 32.
And I think
41.
total debt. Yeah, 41% for total debt.
41 for TDS, yeah. And again, we'll include the link in the show notes, but our ratios article goes into a little bit more detail on how to calculate your GDS, TDS, and your debt coverage ratio, which is your DCR. So next we have track your expenses. So to know how much, it's important to know how much you're spending, so you know how much you can save every month. All right. So there's a few ways to do it. You can do it, old school, pen and paper on a notepad. You can do it via Excel spreadsheet. Or you can use some of the apps that are out there to make it a little bit more simpler for you to track your budget. So a couple ones that are out there that are popular are, one is mint.com. It's created by Intuit, the same people who make TurboTax for you. So it's quite secure. And how it works is the app connects to all your different accounts, your credit cards, your bank cards, your bank accounts, lines of credit if you have any. And every time you spend, it'll automatically tally that spend into your list of items that you spend money on. So if it's gas, it'll tally in the gas. So if you have a budget and you say, I don't want to spend more than $300 a month on gas, if you spend $50 on gas, it'll automatically update that to show you have $250 left for the rest of the month. So it's pretty slick. So every time before you spend, you can always just click on your app, see how much you have left in your budget for that particular category of spending, and then be a little bit more mindful about how you spend. Another one that's quite popular is You Need a Budget, otherwise known as YNAB. So it's a little bit more manual in the sense that you categorize all your spending, it tallies everything, and you have to confirm all the spending. So it kind of keeps you on top of everything you spend. So it doesn't, because the thing with automatic is sometimes you just kind of don't look at it, but this one you have to consciously tally it. So you're consciously acknowledging that you spent that amount. So
yeah, I'm a little bit old school myself. I prefer the spreadsheet because you can kind of, I don't know, I like to update it as I go. And these days you can share spreadsheets with your significant other, so you can look at it together in real time, even if you're in different offices or what have you. But I mean, even with mint.com, I've used a similar one in the past whereby I still use the spreadsheet to build out the budget. And then like you said, you've got to punch in what your budget number actually is for each item before you start, so that, once you connect all your accounts and you're out there doing your thing and spending as you do, that it actually allocates against those original budgets you set up. It's the same thing for looking at your bank accounts to your spreadsheet. If you've got a certain budget for, let's say, groceries, if you budgeted $1,500 a month for groceries, well, a good way to track that is to maybe have a groceries account, a groceries bank account, so that if you're getting to the end of the month and you need to put more money in your groceries bank account, it's very clear and easy to review. Because if it's kind of mixed in with other accounts, it's hard to differentiate what's actually considered groceries, and maybe you went to the movies or something and it's not actually considered groceries, but it's just coming from that same account. It's hard to break that down.
Yeah, for sure. And like the nice thing about Mint is, like, it kind of, if you go to Superstore, it'll show groceries. If you go to Petro, it'll show gas. So it'll automatically categorize it, and then if it's wrong, you can always correct it and it'll remember for next time. Yeah. Another really good old school way is to have envelopes of cash, for different categories. So groceries, you have an envelope of cash for groceries. That's all you can spend for the month. But downside with COVID is no one really uses cash anymore.
Yeah, it's definitely disappearing.
And on top of tracking expenses, always, once you know what your expenses are, set a budget. So set a budget and try to stay within your budget. That's the hardest part. Setting the budget's easy.
Yeah,
keeping the budget
and being realistic is the is the hard part as well. It's no good trying to tie yourself down to the point that it's just not realistic. I mean, you've got to start somewhere and be realistic about it, and do it for a little bit, but just review it, see what's working and what's not working.
And you'll likely need to review it for the first few months, just because you need a few months of data to know just what your average spending every month is, right? Just because one month you might be spending less, but especially once, now we're all in COVID, I think we're all spending a little bit less, So once this is over, I expect your budget to change a little bit, just because you'll likely be going out more, socializing more. Although the amount of money we spend on alcohol might offset that anyway.
I could go on about budgets forever. Like we actually forecast our budget out for actually more than, I would say, just the year. Like we forecast out into the next year and halfway through, and then to the end of that year. Like we really look at where we have different funds coming from. Whether it's a dividend payout or a cash flow check from a property, whether it's a general income, or maybe it's an expense, like maybe it's scheduled maintenance on a vehicle that's going out, and it's not a monthly thing, it's actually just a lump sum when you get to the end of winter, or you're going to get those tires changed, your service done. We really plan all that out and forecast our income, like the works. So not necessarily just about a monthly budget. It's really about the year. Look at the year and roll it into the year after, because if you take a step back for a minute and you think about acquiring properties, this is something that can roll into your property acquisition plan, and you can look at how much money can I actually save over the next 12 months to 18 months to 24 months, and how many properties can I buy with those savings. So when you actually forecast it out in that sense, you can really look at, wow, if I make a change in my budget today, I might be able to actually buy an extra property in 24 months. Whereas if I just leave my budget the way it is, keep rolling for 6 months, you know, it's better to have a bit of foresight and plan a little bit longer down the road and understand how your spending habits can affect your savings later on.
Absolutely, which brings us to our second point. So step
Sorry,
number 2.
I jumped ahead. Sorry.
That's all good. So step number 2, start saving for your down payment, or just start saving in general. So by knowing your budget and by forecasting how much you are spending every month, you have an idea how much you can save every month. So then a good way to do it is just set up an automatic savings account, automatic transfers every month. If you know that you have a good amount that you can put away every month, automatically transfer it, put it into an account that you don't see very often or you can't touch very easily, like a TFSA is a good example, and then just leave it in there and have it done automatically. And after a while, it's surprising that you can just get along with, extra $500 less a month, $1,000 less a month. It's after a while you do get used to it. It seems like a lot at the beginning, but if you budget well and you are mindful of your spending and you set that aside up front, pay yourself first, it's very easy to live off the rest.
Yeah, and if you put it into a TFSA, you can then actually move it into say a low risk fund to maybe realize some benefit on top of just the savings.
Yeah, like a short-term GIC or something like that. At least get you a little bit higher interest than what your savings account can get you in the short term until you have enough to do whatever you need to do with that money. Step number 3, start investing education. Start your real estate investing education. So can't stress this enough. Super important just to, even when you're not getting ready to invest yet, it's really, really important just to develop that knowledge, just so when you have the resources available, when the opportunities present themselves, you're ready to jump on it, right? So read books, listen to podcasts, join real estate investment groups in your area, and connect with other real estate investors that are doing what you want to do. Just because networking in real estate is probably the most important thing that you can do for your career, for your business.
I think, Phil, if I could go back to one of your points there. So you mentioned about the education factor, like reading books and not waiting till you've saved up money to then go and invest and buy real estate. Like, it takes a lot of time to get to that point. Well, it can do anyway, but work on the education aspect until you're ready to kind of make that move. I mean, you're going to continue to learn along the way, but I've had this conversation with a lot of people in the past, and I've had people that have been reluctant to do some coaching. And I've said, look, let's just start with a couple of months and see how it goes. And next thing you know, and they're reluctant because they're like, well, I'm not planning on buying for 12 months or something, like, 12 months or maybe next year or that type of thing. And then you work with them for a few months and they're like, oh, I didn't realize I had to get all these other personal finances in order to get me there. And even just with some clients, working on getting rid of debt before we even get to the real estate conversation and helping them restructure things to just pay things off super quick and get past that, but then continuing that education factor. And then all of a sudden it's like, okay, now they're on a really good path and they can maintain what they're doing, save up at the same time, build their real estate investment knowledge. Then they turn around and say, okay, well, I'm going to be back when I'm ready to buy, because all of a sudden they're just on this path to, I don't know, they know now what they need to do.
Yeah, I mean, what a lot of people don't realize is it takes a long time to develop the knowledge you need to invest successfully, right? To to be able to utilize different strategies, especially if you don't want to just do plain buy and holds, but you want to do other strategies. It takes a long time to develop those strategies, to learn all you need to know to implement those strategies successfully. So, I mean, I remember when I first started investing. I mean, I bought a house, not really knowing what I was doing, and then I started start educating myself with podcasts, books, everything we just mentioned. And I don't think I touched real estate for almost a year. I didn't even look at, I didn't, I looked at investing opportunities, but I didn't really jump on anything for almost a year, just because it felt like it took me that long just to get enough knowledge to be confident to at least implement it semi-successfully. I know I'll be correcting course as I go along, but just to take the next big leap, I felt like it took me a year just to get all the knowledge I needed.
Yeah, I would say I'm probably the same in that regard. I think about 12 months before actually actioning based on the information. Yeah.
So let's move on to step number 4. Come up with a real estate investment plan. All right. So you know your monthly expenses. I hope you calculated that. You have a budget set up. How much do you need to retire? Right. So this is the question you need to ask yourself. And really, to retire just really means being able to cover all your expenses. Like being financially independent really just means having your income being able to cover all your expenses. So how much do you? So you're looking at how much you need, not so much how much you want, right?
Well, if you're just looking at covering base costs, so I look at, it depends on how you view retirement. Like I look at retirement as having choice.
Yes.
Having choice. I mean, it's your choice whether you want to go and do some work, and it might just be a hobby that you've turned into a side business, but you enjoy doing it. It might be you want to go work and help some people out and still make a little bit of money. You might not want to work at all. You might just want to go on vacations, and that's okay too. But retirement's really about just having choice from my perspective.
Yeah, well, the way I look at it is doing what you want to do versus what doing. Sorry, the way I look at it is doing what you want to do versus doing what you have to do. Right.
Totally. So for me, I look at it as the one quantifiable number, and it's very simple. That once you quantify what your single number is, you need to work out how you're going to generate that income while you sleep. This is a very simple question that I often ask people: is how much money do you actually make while you are asleep? Some people look at me and say, well, I make a little bit through this, and that's great. Some people just look at me completely like I'm crazy. Like how do you make money while you sleep? But honestly, that's the truth. Like till you can answer that question, like how much do you need to make while you sleep?
Well, I mean,
then you got to work.
Sorry.
Yeah, then you got to work out how to go and get it, whether it's real estate, whether it's some other sort of vehicle. But you've got to be able to calculate what that number actually is to then work out how you're going to generate that in income.
Yeah, you want to make it passive, right? That passive income to cover to generate the income that you need to live the life you want to live.
Yeah, and I think it is important to break that down to where you were kind of going there, is to your base living costs, your necessities, like the money you need to keep a roof over your head, food in the pantry, and the lights on, and the furnace. Being here in Canada, you have to keep your furnace running. So
like your car expenses, your house expenses, your food, living expenses, utility expenses. So what your base costs, and then that's what you need. And then what do you want, right?
Exactly.
Then you add that on top, and that's the final number that you want to be able to get. But I mean, the base cost is a good goal to aim for, just because once you get to that base cost, you can really step away from your job, right? Once you generate enough passive income to cover your base costs, now you really have the flexibility to step away from your job, knowing that your passive income will be able to cover all your basic expenses. You might not be going on any fancy trips, but you're not going to starve. You'll be comfortable. You can take time off work. You can sit and think and come up with your next plan, or devote more time to the project that is generating you current passive income.
Yeah, absolutely. You can refocus, you can shift your focus, and all of that time that you were applying to a day job, you can then shift that to anything else that you want to do.
Mm-hmm. And then focus, and then that way now you can focus on creating the income that you want versus just the one you need.
Yeah, because you're not capped.
Mm-hmm. And if you're doing real estate, a conservative estimate is about 4 to 8% of your portfolio worth, the worth of your portfolio. So say you have a $1 million portfolio. So in a 4 to 8% of that is between $40,000 to $80,000. Am I right?
Yeah, that's right.
Yeah,
So
yeah,
that's
40
what
to
it,
80,000
that's what
a
it'll
year.
generate.
Yeah, $40,000 to $80,000 a year for a $1 million portfolio once everything's paid off.
And that's
So,
gross. That's gross revenue.
Gross
That's
revenue, correct?
Revenue
Yeah.
that portfolio would generate roughly.
Yeah, pre-tax. So that gives you an idea of how much real estate you need to accumulate in order to get to that number that you want.
And to take that a step further, I mean, we could chew up a lot of time talking about this, but this one I really like. I mean, this is something that I work really closely with my clients that I coach on trying to establish all of this before we even get to the nuts and bolts of the real estate stuff. Like, this is really important. Like, if you can quantify, let's say, Phil, that your number is 2 million, it's 2 million, and you know that that'll generate, based on the 4 to 8%, $80,000 to $160,000 a year, somewhere in that range. Well, you might look at that and say, well, if I know that the property portfolio that I need is 2 million, do I want to do that with 4 $500,000 houses? Or do I want to do it somewhere like Lethbridge with 10 $250,000 houses? You know, because realistically, it's not really going to matter, but it matters where you are, what your preference is, what your location is. Do you want them close to home? Like, then you can start really building out an acquisition plan, and then go back to your budget and back to your income forecast and look at when you're going to have down payments available to go and purchase those properties. If it's 500,000 and you need 4, that's beside your principal residence, just investment properties. But you might look at that and say, well, I need, you know, I could use maybe 5 or 10% down payment and live in the first one, and maybe do that one more time and then move on. And then you would need 100,000, 20% down payment for the next 2. So it starts to become really plausible when you put it in that perspective.
Mm-hmm. And it's also makes it very achievable, right? Just because a lot of people think you need, 30 doors, 40 doors to really achieve the life you want. But if all you need is 8 or 5 to achieve that life you want, then it's very, very easy to, it makes it much more manageable in terms of trying to achieve that goal versus aiming for something that seems overwhelming and far away that you can't really see where it ends.
Yeah, it really has to relate back to your personal quantifiable number, because everybody's different. Like, your wants and desires are different to the next person. So if you work out your dollar value that you need, and then you can establish the portfolio size, and then you can start looking at how many properties make up that portfolio and how you're going to start to acquire them.
And just because you see people who have like 50 doors doesn't mean because you have to remember, everybody has different circumstance, everyone has different opportunities and starting means, right? Just because maybe they had an inheritance that they were able to distribute and buy those properties. Like, you don't really know. So do what you can as best you can with the plan that you have, and don't not to say you shouldn't learn from others, but but each to their own, right? Everybody's investment plan is unique.
Phil, I think it's important to not, what's the word I'm looking for here? Not compare yourself.
Yes. Like, it's not a competition.
Yeah, and it's just completely irrelevant, honestly. Like once you start to understand your quantifiable number and you start working through your budget and you start looking at how you can cover your expenses and things start coming together and your plan starts coming together, what everybody else is doing is completely irrelevant to your situation. Because I can
Yes.
tell you right now, once you can make it work, and all of a sudden your time is yours, nothing else matters.
Yes. And then know at the beginning, it's very hard to not compare yourself to others, but just keep reminding yourself that everybody has their own circumstances that brought them to where they are. And no two people have the same circumstances. So just because someone is doing perceptively better doesn't mean you're not still doing just as well on your own path, right?
Yeah, and God, it just doesn't matter.
It doesn't. No, in the end, it doesn't matter. No, just follow your own path, follow your own goals, follow your own, plan. Follow your own plan.
100.
Step number 5. Look into getting pre-approved for financing. So you want to, once you have your budget set up, once you have to start saving, you want to know how much house the banks will let you afford. Right?
This is kind of a good one too, to be ready to take advantage of an opportunity should it pop up.
Exactly. So because this way the budget that you can afford. So you can afford a $400,000 house, but a $600,000 one pops up. If you don't know that you can't afford it, you still might try to jump on it, which will just be a waste of time in the end, right? So that way it allows you to filter down the type of properties that you can, the type of opportunities that you can jump on. So in this case, it's important to find a mortgage broker that is investor focused, so they know how to structure a financing plan that will fit your goals.
Yeah, and that's a really good point, because if you plan to buy a certain amount of doors, like if you really, once you've done all your base living costs, and you understand what your numbers are and how many properties that you like to acquire, well, your plan might be different to the next person. You might be looking at some residential mortgages first and then rolling things into commercial and then moving back to residential. There can be multiple ways to set it up. So it's really important to speak with a mortgage broker who understands those different aspects. Not somebody, like, to be honest, any mortgage broker can likely get you to the point where you can buy a house. There's a lot of different mortgage products out there, and different types of lenders, different grades of lenders. But does that fit with your long-term strategy and your investing goals?
And it's important I find it's important to actually go to a mortgage broker versus actually just go into a bank, just because there are a lot of financing products that are not available to the average consumer, like not readily available to the average consumer, like monolines and other credit services that makes it a lot easier for the mortgage broker to get to, because some of those financing products you need to tap certain financing products first before you jump to the big banks, because otherwise you can really hit the financing wall a lot faster than you otherwise would.
And there's different ways to set things up to access capital sooner rather than later as well.
Yeah. So super important. Get a good broker that's investor focused, and tell them your plan and help them figure out a way to carry out your investing plan.
And one thing I would also say is that the interest rate is not the most important thing.
Good point. Yes. Yeah. Just because sometimes the terms of the mortgage might be more worthwhile than a lower interest rate. So number 6. We're number 6. Determine your market. So determine the market that you want to purchase. Where do you want to buy your investment properties? So we talked a little bit about, again, I'll put this in the show notes, but we talked a little bit about macroeconomic fundamentals. So we talk about, places where there's job production, there's influx of people, there's a stable economy with multiple major employers. So those are important things to look at when you're finding a city or a town or municipality that you're trying to invest in.
There's a real simplistic way to say this. There needs to be a reason that people are in this location.
Mm-hmm.
And that there, from my perspective and Phil's perspective, there needs to be multiple reasons. But that's really, from a very simplistic perspective, there just needs to be a reason that people either frequent that place or they want to be there.
Mm-hmm. So you want people moving in, really. That's the main goal. And ideally, you want, if it's your first investment, I do recommend you having a place where you can manage it yourself, just because that act of managing the property teaches you so much. Especially before you hire a property manager, you want to know how to manage it well. So when you hand it off to a property manager, you know that they're doing a good job. So ideally, you want this property to be within 2 to 3 hours of where you live, just to make it easily accessible. I mean, if it's down the block, great. But if it's, if it's not in a place where there are good fundamentals and the place where you want to invest is a little bit further, within 2 or 3 hours is reasonable. Anything more than that becomes very difficult to self-manage, I find. So
I get, sorry.
Sorry, go ahead.
To kind of go back to your determine the market. I mean, yes, there needs to be a reason, but for people to want to be there. But you're right, like there are specifics to that. The specifics are the employment, the education factor, the medicinal. Like, is there local hospitals? Like, what's the infrastructure of the town or the city?
Yeah.
Like, what do they
Transportation
have?
routes. Yeah.
Exactly. How can people access? Is there an airport there? Like, these factors are important. Like the manufacturing sector, is that apparent in that location? Like, what is that location connected with? Other, is it a hub for other towns, or is it an outlier to a hub? So all of these things are important. And what historically, if you were to review the population growth, has it been growing or declining? Like, what historically has been happening, and are big retailers setting up shop? Like, think about it from this perspective. Costco is not going to build a multi-million-dollar facility in a location that does not have the people to support the facility. So the research and planning that goes into the development of an area by large corporations is a good indicator of what that future plan looks like for an area.
And a good place to look is also the city website. See if they have any upcoming infrastructure developments in that particular area as well. But we're looking more into the microeconomics, right? We're looking more into the specific area and whether or not that area will perform. But as a whole, you want to know that there are major employers, that there is an influx of people, that there are jobs being created in the area, and there's multiple employers. So then, if one employer fails, that 1/3 of the population will be out of a job, and it's well diverse. Then that the economy is well diversified to withstand any economic downturns. And so, step number 7, determine your ideal tenant. So this is something I like to do. I know, Brad, I don't know if you do the same thing, but
not. I know your process, Phil,
Yeah.
and yours is a little bit different to mine, because you start a little bit more with this. I start a little bit more with the investment side, but
let's go over both.
Okay, cool.
Yeah, I think both strategies work, because we both seem to be doing okay. So let's go over both. So what I like to do is I like to first create what I call a tenant avatar. So basically, I kind of come up with the structure of my ideal tenant. And I go into specifics, like how old they are, where they want to live, what type of income are they producing, what type of education have they gotten, and that kind of gives me an idea of what type of tenant I want in my property and what type of tenant to market to. And then from that perspective, I also have an idea where they want to live. So that would look at areas in the city that they would want to buy, or they would at least want to reside. And then I kind of spent all my energy focused on those particular areas, that would attract those type of tenants. So for example, my preferred tenant profile are young professionals. All right. So young millennials, or middle-aged millennials now, we're getting to the point. and what they would want. So typically, newer properties in areas with good walkability, easy access to transportation routes, easy access to commercial areas like shopping, food, stuff like that. Relatively newer neighborhoods, or trendier areas like in downtown, White Ave in Edmonton, or 17th in Calgary, stuff like that. And so I was just looking in those areas, just try to focus on those particular tenants and buy those properties that they want to buy. Brad, what's your tactic? What's your strategy on this?
Yeah, it's funny because as you went through that, I realized that our analysis and review process is actually maybe a little more similar than we thought. But so I'll give you a perfect example of how I came to understand Lethbridge from a microeconomic standpoint. So I reviewed Lethbridge from like a major employer standpoint. So major employer is an employer that employs over 100 people or 100 people or more. And so when you look at that list, it's actually larger than what you might expect. I looked at population growth, but then I dove into, once I looked at all of those factors and I looked at the city as a whole, and I saw that the population was increasing at a yearly rate of around 2%. I thought, okay, this is interesting. Then I started diving through the statistics on the different areas in Lethbridge. So Lethbridge is broken down into the west side, which you have the university, the south side, which you have the college, and then the north side, which is a little bit more of the manufacturing. So what I did was I actually started looking at the historical house price index statistics for those different areas. And I would go back month over month and I would look at year over year, and I would really dive through all of those numbers and do my calculations and really understand the trends for those housing, for those home price indexes for those specific locations. And what I understood from that was that the west side was continuing to grow, and I looked at major projects as well, and I saw that money was being spent up on the west side to build almost, I think it was around a couple of $100 million of leisure center, ATB leisure center up there, phase 1 and phase 2. I looked at the $260 million build that was happening at the university. So I really looked at all those different factors and the numbers where the west side was starting to show house price increases. The south side, I looked at the downtown core, and not an overly big amount happening down in Lethbridge, but I believe over time with steady population growth that the downtown core will hopefully one day become a little bit more of a built up hub eventually here. But I also looked at the way the land is built out in the south side, and you're kind of locked in between the downtown area, Scenic Drive and the Cooley there, and then May McGrath. So you're locked into this location, and house prices were steadily increasing on the south side too. The north side, not so much. Lower demographic up there, and house prices were you would say either 0% or maybe slightly declining. So after I did all of that analysis, I looked at those locations and said, okay, now what type of profile do we have? We've got people that can access the core easily for work. We've got people that are going to access the college likely. And then on the west side, we're probably going to have a little bit more family integration with students up on that west side that are at the university. So that is how I went through my analysis of Lethbridge. So maybe not necessarily starting with the tenant avatar or tenant profile, but the house price index is kind of really relates to demographic. Like when you're seeing house prices increase, it's becoming more and more expensive, and people have to be able to afford and afford and afford. So it starts to change as things increase in prices. Home prices increase, so does the demographic starts to change along with that. And that's what I mean by our analysis. Like
I
it's
think
just
we're
closer
getting
than
to
we
the
think.
same. I think we get to the same point. We just come in from different angles, right? Because I mean, I do all that after I decide who my tenant profile is, and then I start looking into different neighborhoods. We'll go into that a little bit more later, in terms of becoming a geographic specialist. But when I go into look into different neighborhoods and then look at more specific, like where major transportation routes are, how house prices are moving in those particular areas, where different socioeconomic classes like to, how they're isolated or how they're distributed, and then from there I kind of focus in on an area that kind of fits the profile, not only my tenants but also the type of property profile that I want as well.
Like I will say one other thing is I definitely look at what is available to rent.
Yes.
Because if you've got a massive oversupply, like Calgary downtown right now, I mean, maybe it's not the right place to buy a rental property.
Yeah, same with Edmonton downtown now too. They just put up the Legends Tower and the Sky Tower. So they have well over 100 plus units. They just 100 plus, a few hundred units of condo units. They just flooded the market and within a 2-block radius.
Yeah, there you go. There's a perfect oversupply. So I mean, if you're going to buy one with the intent to rent it, it's going to drive rents down for sure.
Absolutely. And I mean, the reason I'll go a little bit further. The reason I chose a tenant avatar method first is because when I first started investing, especially a lot of new investors, they're very focused on price, right? Just because it's such a capital intensive venture that after you buy one or buy two, then you start looking at cheaper and cheaper properties because you're running low on money. And then I remember I was looking in certain areas where you can buy a suited house for $240,000 in Edmonton. But then if you look at the socioeconomic area, you realize like, okay, it's Alberta Avenue. It's kind of like, what I guess the equivalent in Calgary would probably something maybe like Dover or Salon. Like, it's just, I mean, it's not like it's a bad area. It's gentrifying, but are the type of tenants there the ones I want to deal with? Right?
Yeah, it can create more work in the long run if you're not careful.
Yeah, and it might, you might quit the real estate investing business before you really get rolling if you start with a few bad apples. So,
or your appliances disappear overnight.
All right. So next one. So step number 8: start building your real estate power team. All right. So what does that mean? So this means all the people that would help you put a deal together. So you have a mortgage broker. We've already talked about that. Next you'll likely find a realtor to help you find a property that you want. Right? A lawyer to help you draft a deal together. And it's important to find real estate these professionals that are familiar with dealing with real estate investors. Just because what we do compared to the average home buyer is a little bit different. How we structure things are a little bit different because we need to look in the long run, look at the long-term play of how we want to build our portfolio. A homeowner, all they really want is just buy the one house. 5-10 years later, they might buy another house after selling this house. So it's really easy and transactional. But for us who want to collect properties, it's a little bit more sophisticated, a little bit more complicated. So it's important to find people who are familiar with dealing with that level of complexity versus your day-to-day homeowner. Bookkeepers, also super important one. Can't emphasize that enough. Home inspectors, you want a good home inspector that, again, real estate investor focused, knowing what they're looking for. And accountants. right? Just to make,
Mhm.
again, just to do your books. Gets a little, once you, one or two properties easy. Once you get into higher numbers, once you get into commercial, once you start developing once you get incorporated, all that adds complexity far beyond what a regular homeowner would experience.
Yeah, for sure. And if you've got multiple sources of income, like if you're still working a day job and now you're starting to make money with your real estate, maybe you have a couple of side hustles as well, but you really want to, you can utilize your real estate in multiple ways to actually offset taxes that you may have to pay due to having these multiple sources of income as well. So it's important to be able to sit down or have a conversation with your accountant to understand what that looks like and what the ramifications are for doing that. Because if you're going to use real estate to offset taxes now, well, that is going to have an impact later on. So anyway, that's a really good point. Accountant is top of the list for me as well.
And in order to find good power team members, best way is ask for referrals. Network with other real estate professionals, see who they use, and then see if you can use the same people, because they're good already, so you don't have to reinvent the wheel, start from scratch. So step number 9, learn how to analyze properties. So now we're getting into what we like to call the microeconomics of property analysis. So when the macroeconomics was figuring out the city, the population, socioeconomic, all that stuff. Now we're looking at a specific property and how to analyze property to know whether it is a good investment. I don't want to go too deep into it, but basically you want to comes down to how much rent can you get from the property. You can find that on different rental websites, Kijiji, Rent Faster, Rent Board, in that particular area. And then how much expenses, how much will it cost you to run that property? So your taxes, mortgage, insurance, utilities, and whether you're coming out on top, whether your rent covers your expenses, right? That's really what it comes down to. There's a lot more into it. There's a lot more to that.
Yeah, and look, I mean, you can get really granular with it and look at your percentage of maintenance. You can look, obviously, don't forget if you've got a condo or a property that has condo fees, that's going to eat into your cash flow a bit. So bear that in mind if you're looking at different types of properties to invest in. But yeah, I mean, at the end of the day, like Phil said, you want to understand your income versus your expenses. If you're looking at a property and it's showing between 5 and 10% cash flow, then maybe you're onto something and it's going to be a good deal. But we talk about it all the time, and you need to have some money in the bank somewhere as a reserve fund. It doesn't, like we would typically have an account set up for a property, and there would be money in that account for that property. And if not, there's money somewhere else that if we need to access or we need to draw from, we can to service that property should we need anything. So,
and make sure you have a different account for every property, just to make things a little bit easier on the bookkeeping and accounting side, just to keep track of all your ins and outs. But yeah, learn how to analyze properties well. On our website, cwho.ca, we have a really, really good investment calculator. All you have to do is punch in all the numbers, and it'll spit out income, percentage return. That'll determine whether or not it's a good property. So yeah, very easy to use.
It's free to use as well.
Yes,
so
it is.
You can download reports. You can actually download the report that it will generate, and you can put a joint venture percentage in there as well. If you want to look at it from a joint venture perspective, it'll actually tell you what that investment will do from a percentage of ownership.
So really good calculator, yeah. So yeah, check it out. It's under our tools section or our calculator section of our website. And really good idea to analyze at least one deal a day, just because it's important to get practice looking at different deals to know what is a good deal versus what's not a good deal. If you do enough, if you analyze enough deals over time, you can simply look at a property and kind of tell right away whether or not it's a good deal. So it allows you to jump on those opportunities when they present themselves faster than the next person who has to go through all the math from beginning to end. If you've already done all your research with regards to your macroeconomic, with regards to your tenant profile, and you've done your deal analysis enough times, it'll be very easy to spot a good deal and jump on that before anyone else gets to it. And lastly, step number 10, become a geographic specialist. So you choose Calgary, right, as an example, and you know the Calgary is where you want to be. You kind of know where you want to be in the Northwest, just because you find there's a higher socioeconomic population in that area. So now you want to focus more on the neighborhoods, because neighborhoods do make a difference in terms of, again, tenant profiles, socioeconomic classes, access to transportation routes, access to different conveniences. So you want to be a geographic specialist and just really narrow down in an area and start analyzing deals that pop up in a specific neighborhood. Just because that way, you know the range of prices that show up in the neighborhood, the type of properties show up in the neighborhood, and then you know what a good deal is when you see it. You can do it all over the city, but who has enough time? Right? That's the problem.
Yeah, and I mean the other thing about that is it doesn't mean that neighborhood works either. Mm-hmm. You might analyze a bunch of properties and be like, I can't get any of these to cash flow, and it might simply be that the cost of the property is just too high for what it will generate in rent.
Yeah. For example, I want to invest in Mount Royal.
Yeah, I mean, if you're looking for cash flow, maybe not the best location to do that. But that just means that you need to move on to another neighborhood and just work your way around, work out some good locations to invest in for the strategy that you want to employ before you jump in.
Mm-hmm. And also with Calgary, it's also important to note the zoning bylaws as well, like how the properties are zoned in those particular neighborhoods. Just because the zoning might not actually fit your strategy. If you want to do secondary suites, you might, and you want to do it in an area that's all R1, that might be more difficult than if you chose an area that's R2 friendly, right?
Mm-hmm. Absolutely.
Mm-hmm. That's really it. And once you have everything, the only thing left is to make an offer. Right?
Yep. Sign the paperwork.
Yeah. So there we have it. 10 steps to get started in real estate investing. Anything else you'd like to add, Brad?
Like you said, make an offer. There's an taking action component that is built into that make an offer. Mm-hmm. Like once you go through this process, you get yourself into a good position. You network, you've got good people that you can contact and ask questions to, and then you really, the onus is back on yourself to action what you've learned and to get yourself into the game. Yeah,
always take action. Not to say that none of this is not taking action, but I think that making the offer is a big step for a lot of people. And
it's exciting too.
It's
an exciting time. Like,
but you shouldn't have a lot to be scared of, right? Because if you have all this in place, if you have your down payment ready, you have your financing ready, you know your area, you know your tenant profile, you have everything set. That offer you should be excited to, hopefully you want that offer accepted at that point, right? You shouldn't be afraid to have the offer accepted, just because you should be ready to just, pedal to the metal and just go at that point.
Yeah, I think it gets, I don't know, it's less nerve-wracking the more you do it, but
yes,
it's exciting. It's
no, the first time was scary. I'm not gonna lie, man.
Yeah, it's scary, exciting.
First time was scary. It's just like, here's 80 G's on a house, and it's like, is it gonna work?
Yeah, and then you'll hit the capital barrier, and then you'll start looking at alternative strategies to buy real estate.
Mm-hmm. Well, that's another podcast.
Yeah, exactly, totally.
All right,
good, cool. Awesome. Well, thanks, guys. Enjoy and good luck.
Yeah, enjoy. Happy investing, guys, and see you guys next time.
Thank you for listening to the Commonwealth Home Ownership Podcast. Be sure to check out all of our past episodes and our ever-growing library of content at cwho.ca. Until next time, Remember to get out there, take action, and create a life of wealth by design.